Hello and welcome to Impact Tuition. We wish ourselves well this new year, and we pray that as we prepare for the April 2022 ICA Ghana exams, all goes well with us and we are successful at the end of the day. Today we begin our discussion on consolidated financial statements, and this will be an introduction to basic consolidation. Before we begin, if this is your first time of watching Impact Tuition, please subscribe, like and share our channel to friends who would also need this revision class. Thank you. I will begin with basic consolidation. Basic consolidation. Consolidated financial statements are financial statements for group activities prepared as one unit. So in consolidation, we bring parents' investments together in one set of financial statements. Separate legal entities accounted for in a group as one economic unit. That is all we do in consolidation. Now, IFRS contains rules that require the preparation of a special form of financial statements in situations where one entity A controls another entity B. Rules for consolidation are contained in IFRS 10, Consolidated Financial Statements, and IFRS 3, Business Combinations. There are other standards as well, IAS 27, IAS 28, IFRS 11, IFRS 12, that deals with other issues in connection with consolidated financial statements or consolidated accounts. We have a group of companies made up of a parent and a subsidiary or subsidiaries. When we talk about the group, this is just an introduction, so I'll be brief and I will later dive deeper into it. So group is made up of a parent and then a subsidiary or subsidiaries. Now, if a parent has control over a subsidiary, then that parent will prepare consolidated financial statements. A group consists of a parent entity and one or more entities that it has control over. Now, these entities are the subsidiaries. The entities that ultimately controls all the entities in the group is called the parent. Some parent companies have no assets at all except shares in the subsidiaries of the group. Such a parent is sometimes called a holding company. Now, a group consists of a parent and its subsidiaries. A parent is an entity that controls one or more entities, and a subsidiary, an entity that is controlled by another entity. And the purpose of preparing consolidated financial statements is to provide, let's do this, purpose for consolidation. Purpose: provide financial information about the parent and its subsidiaries. Provide financial info about the parent and subsidiaries. Show economic resources controlled by a group. Show resources. No, economic resources controlled by the group. Show obligations of the group. And then show the results achieved with group resources. Achieved with group resources. Right, so this is the purpose of consolidation. We want to provide financial information about the parents and subsidiaries, show economic resources controlled by the group, show obligations of the group, and then show results obtained or achieved with group resources. Now we should note that we have to first understand the type of investment made by the parent and the implication for group accounting first and foremost. This is very important because not all investments will lead to control, and if you don't have control over your subsidiaries, you can't prepare consolidated financial statements. You will look at control later on in the discussion. So first and foremost, you must understand if the investment in the subsidiary will make the subsidiary, or let me put it this way, you must understand if the parent's investment in the other company, so say A and B, if A invest in B such that A has 50% plus of the shares in B, then A is the parent and then B is the subsidiary. So in this case, A should prepare consolidated financial statements. There are instances where the investment of A in B is 20% or less, and that is another situation. In that instance, B becomes an associate where A will have significant influence, and then we have situations where two entities will come together to carry on an activity, which is a joint arrangement. Alright, so you must first understand the type of investment the parent has in the subsidiary or in the second company to determine whether to consolidate or not. With that said, we will look at some relevant standards. Relevant standards. There are quite a lot. So we'll look at IAS 27. Excuse me. IAS 28, IFRS 3, IFRS 10, IFRS 11, and then IFRS 12. So basically, for basic consolidation, these are the standards we'll be considering. So I'll just give a brief description about the standards and what each of them contain. IAS 27 prescribes how the investor shall present his investments in the individual or non-consolidated financial statements. That is IAS 27. IAS 28 outlines how to apply, with certain limited exceptions, the equity method to investments in associates and joint ventures. That is IAS 28. Now, IFRS 3 outlines the accounting treatment, or outlines accounting when an investor obtains control over its investments. It also shows or prescribes how to account for goodwill, non-controlling interest, and the assets, liabilities acquired. We'll look at all this later. Now, the actual consolidation is, or the consolidation rules are in IFRS 10. So here the standard defines control and then gives guidance to identify whether there is control or not, and then prescribes the consolidation procedures for preparing consolidated financial statements. Talked about IAS 27, 28, IFRS 3, IFRS 10. Now, IFRS 11 talks about joint arrangements. Now, the arrangement can be a joint operation or a joint venture. In both cases, the investor obtains joint control over some business with other investors. Now, in such a situation, we will apply IFRS 11. Now, IFRS 12, disclosure of interest in other entities. We will look at all of these later in detail as we proceed. Okay. Right. Like I mentioned, this is an introduction, so we will quickly go over certain aspects of the consolidated financial statement process, and we will later dive deeper into them. Let's discuss control. Control. We mentioned earlier that an entity that has control over another entity should prepare consolidated financial statements. Now, an entity is a subsidiary of another if it is controlled by that entity. An entity is a subsidiary of another entity if it is controlled by that entity. Now, the standard IFRS 10 says that an investor controls an investee if and only if it has all the following. Your control exists if all the following exists. So control if all the following exists. What are they? The parent has power over the investee. The power over the investee. Exposure or rights to variable returns from its involvement with the investee. Exposure or rights to variable returns from its involvement with the investee. Then the ability of the parent to use the power over the investee to affect the amount of its returns. So ability to use power. Right. So where these conditions exist, then obviously the parent has control over the subsidiary. Now, in the vast majority of cases, obtaining a controlling interest means buying shares which gives the holder more than 50% of the voting rights in the other company. Now, this is very important. Those situations where control exists. Situations where control exists. I'll repeat that again. I'll repeat that. In the vast majority of cases, obtaining a controlling interest means buying shares which gives the holder more than 50% of the voting rights in the other company. An illustration: Company A, Company B. 100% of the shares in B. Now A obtains 50% plus of the voting rights, or 50% plus of the shares in B. The moment this happens, A obtains control of B. So in such a situation, we can clearly say that control exists. Now we have wholly owned subsidiaries. Wholly owned subsidiary, where one entity owns 100% of the shares in another. So wholly owned subsidiaries. Entity A, Entity B. A owns 100% of the shares in B. There are no other investors, so in such a situation, B is a wholly owned subsidiary. We have partially or partly owned subsidiaries. Partly subsidiaries, A, B. A owns 80% of B's voting share capital. So anything less than 100% is partly owned because there might be other investors. So for example, if A owns 70% of the shares in B, B is a partly owned subsidiary. Now, A has controlling interest, and then of 70%, and the 20% is owned by other parties who are known as the non-controlling interest, or NCI. Now the NCI, we should note that the equity in a subsidiary not attributable directly or indirectly to a parent, that is the NCI. So simply put, parent owns 70% of the voting rights of B. The 30% is the non-controlling interest, which is the interest in B owned by other parties. Control is assumed to exist when a parent owns directly or indirectly through other subsidiaries more than 50% of the voting power of the entity, unless in exceptional cases it can be clearly demonstrated that such control does not exist. Control is assumed to exist when the parent owns directly or indirectly through other subsidiaries more than 50% of the voting power of the entity, unless in exceptional cases it can be clearly demonstrated that such control does not exist. We will take a very quick example of that. So from this we should understand that having control can be direct or indirect through other subsidiaries. You have A, B, and then C. A, B, C. A owns 60% of the rights in B, and then B owns 70% of the rights in C. In a situation like this, B is a subsidiary of A, and then C is a sub-subsidiary of A. This situation comes to play when we are dealing with complex consolidation. We should also note that in certain cases, a company might control another company even if it owns less than half the voting rights. Such a company is said to have a de facto control. We mentioned earlier that to control an entity, you should have 50% plus of the voting rights. But in situations, a company might have control even if it owns less than 50% of the voting rights. A situation is where A owns 45, A owns 45% of B's voting rights or voting share capital. The other shares are held by a large number of unrelated investors, none of whom individually owns more than 1% of B. So, A owns B 45% of the shares of B. Now this is clearly less than half. But in this situation, A could have control if the other shares are held by a large number of unrelated investors, none of whom individually owns more than 1% of B. Now it would be unlikely that a sufficient number of the other shareholders could come together to stop A directing the company as it wishes. We have about 55% of the shares owned by a large number of people, and none of these people have up to 1%. Now it is so unlikely that they will all come together to vote against A directing the company as it wishes, since A has about 45%. In such a situation, A is said to have control, even though A owns less than 50% of the share capital or the voting share capital of B. There are other situations where A owns less than 50%, but it has an agreement with other shareholders which allows it to exercise control. We are still discussing situations where control exists. A, B. A has 45% of B. Now, A has gone into an agreement with other shareholders, which allows it to exercise control. In such a situation, A is said to have control because of the agreement it has with the other shareholders, which gives it control. A, for example, A owns 45% of B's voting share capital. A further 10% is held by A's bank, who have agreed to use their vote as directed by A. So 45 plus 10 is equal to 55, and this gives A control over B. Now this 45% holding of A, together with its power to use the votes attached to the bank shares, gives A complete control over B. Alright, we've already discussed the purpose of consolidated financial statements. Now, in preparing consolidated financial statements, the assets and liabilities things to note. Excuse me. First, let's discuss the exceptions to consolidation. Exceptions to consolidation. IFRS 10 states that within certain exceptions, a parent must prepare consolidated financial statements in which it consolidates its investments in subsidiaries. Exceptions to consolidation if all of the following apply. 1. The parent itself is a wholly or partly owned subsidiary of another entity, and the entity allows the parent to avoid preparing consolidated financial statements. So, the parent, say X, is wholly or partly owned by Y, and Y allows X to avoid preparing consolidated financial statements. Consolidated financial statements. This is the first exception. The parent is a wholly or partly owned subsidiary, and the owner allows it to avoid preparing consolidated financial statements. The next, the parent's debt and equity instruments are not traded in the public market. Parent's debt or equity instruments not traded on the public market. Three, the parent does not file its statements with a Securities Commission for the purpose of issuing financial instruments to the public. Does not file statements with SEC for the purpose of issuing shares to the public. And then finally, the ultimate parent company produces consolidated financial statements for public use. Ultimate parent produces consolidated financial statements for public use that comply with IFRS. So these are the exceptions to consolidation. Apart from this, companies which controls other entities should prepare consolidated financial statements. Let's look at sundry issues. Sundry issues. There are quite a number of them. Both the parent and subsidiary should have a common reporting date. Common reporting date. Should be uniform accounting policies. uniform accounting policies, and some others. With this, the financial statement of the parent and subsidiary must have the same year, and unless it is impracticable to do so. In addition, the reporting date of the parent and subsidiary must not differ by more than 3 months. With this, since consolidated financial statements combine the assets, liabilities, income, and expenses of all the entities in the group, it is important that the methods used for recognition and measurement of all these items should be the same for all the entities in the group. Basically, we'll be combining assets, liabilities, and expenses and other things of the group. So it is important they have uniform accounting policies so that the combination of these items would be easier. Now we come to the main thing: consolidated statement of financial position. Consolidated statement of financial position. The basic approach. We have already mentioned that consolidated financial statements is the financial statement of a group presented as those of a single economic entity. What is the consolidation procedure? Consolidation procedure combine like items of assets, liabilities, equity, income, expenses, and cash flow of the parent with those of the subsidiaries. Combine like items, assets, liabilities, expenses, and cash flow of the parent with those of the subsidiaries. Next, offset or eliminate the carrying amount of the parent's investment in each subsidiary. Offset or eliminate the carrying amount of the parent's investment in each subsidiary and the parent's portion of equity of each subsidiary. That is the next thing to do. Next, eliminate in full intragroup assets, liabilities, equity, income, expenses, and cash flows related to transactions between entities of the group. Where there are intragroup activities, so eliminate all intragroup activities. I will take examples and discuss each of these in detail. Groups might trade with themselves. Now in consolidation, we have to eliminate all intragroup activities. So these are the consolidation procedures. First, combine like items, assets, liabilities, expenses, cash flows. Then you eliminate the parent's investment in each subsidiary with the parent's portion of equity of each subsidiary. Then we eliminate all intragroup activities. Now when we are done with consolidation, we would see that the parent's cost of investment in the subsidiary in the parent's statement of financial position disappears in the consolidation. Each consolidated assets and liabilities is an addition of the parent and subsidiary's assets and liabilities. The share capital in the consolidated statement of financial position is always just the share capital of the parent. We should take note of this. After we are done with consolidation, the parent's cost of investment in the subsidiary in the parent's statement of financial position disappears in the consolidation. Each consolidated asset and liabilities is an addition of the parent's and subsidiary's assets and liabilities. The share capital in the consolidated statement of financial position is always just the share capital of the parent. Let's look at some major workings we'll be doing in consolidation. Major workings. Right. We have three major workings. Calculation of goodwill. Calculation of consolidated retained earnings. And then the calculation of non-controlling interest, NCI. Now, in order to calculate the above figures, information about the net assets of subsidiaries at acquisition and at the date of consolidation is needed. So we have a simple calculation set out in this format. The net asset of subsidiary we have at acquisition, and then at reporting, then the movement or the difference. Share capital of the subsidiary at acquisition, then the movement, retained earnings at acquisition, at reporting, then the difference, which is the movement. assets, give us the net assets at acquisition, and then at reporting, and then the movement. Now this difference down here is the post-acquisition profit. Post-acquisition profit, which is shared between the parent and the subsidiary using their ownership percentages. The next is the consolidated retained earnings. Consolidated retained earnings. And the retained earnings of the acquired subsidiary at the date of acquisition is the pre-acquisition profit. Only profit earned by the subsidiary since the date of acquisition is included as retained earnings in the consolidated financial statements, called post-acquisition retained earnings. Pre-acquisition profits of the subsidiary are not included as retained earnings in the consolidated financial statements. So in calculating our consolidated retained earnings, we are only looking at the retained earnings of the subsidiary after the acquisition. So the consolidated retained earnings is set out in this format. All of the parent's retained earnings of the parent P's retained earnings. We have the Ghana CD here. Now the parent's share of the post-acquisition retained earnings. Acquisition retained earnings of the subsidiary. That will give us our consolidated retained earnings. This is an introduction. We will have time for word examples. We should know that this same basic rule applies to other reserves the subsidiary has other than retained earnings. So any other reserve the subsidiary has other than retained earnings, we apply the same rule. Only the post-acquisition difference is what is shared between the parent and the non-controlling interest. Next, we look at the calculation of goodwill. Goodwill. Now, goodwill is an asset representing the future economic benefits arising from other assets acquired in a business combination that are not individually identified and separately recognized. That is goodwill. Goodwill is not good name like we were told in the high school. It is an asset which represents the future economic benefits arising from other assets acquired in a business combination that are not individually identified and separately recognized. So we put all of these things together, and that becomes the goodwill. So in acquisition, the parent will normally pay an amount in excess of the value of the assets. That excess is normally attributed to goodwill. Now, goodwill is calculated at the date of acquisition. You should note that. Calculate goodwill at the date of acquisition. How is it calculated? Consideration transferred from the parent to the subsidiary Now we add the NCI, non-controlling interest. The net assets acquired, and this is determined in accordance with Ifrs 3. We deduct. Now this will give us goodwill at acquisition, with less impairment in goodwill, and the final thing is the goodwill at reporting. Goodwill at reporting. We will pick specific examples and work things out so we understand. Now, goodwill is recognized as an asset in the consolidated statement of financial position. At the end of every year or annually, goodwill should be tested for impairment, which is the subject of another standard. Non-controlling interest, NCI. When a parent acquires less than 100% of the equity shares in a subsidiary, the remainder of the shares in the subsidiary are held by other shareholders called the non-controlling interest. Parts of the net assets that have been consolidated belongs to the NCI. A figure for the NCI is recognized in equity to show their ownership interest in the net assets. So at the reporting date, we include a figure for NCI to show the interest of other shareholders who do not have control in the consolidated financial statements. So NCI is calculated in this manner. The NCI at the date of acquisition NCI share of post-acquisition retained earnings, and then the NCI share of other post-acquisition reserves. NCI share of other post-acquisition reserves, if any. This will give us the NCI at reporting. Good. We should note this. There are two ways of measuring NCI at acquisition date. Let's quickly look at this. NCI at reporting date can be measured in two ways. The first, as a percentage of the net assets of the subsidiary at the date of acquisition. Percentage of net assets at acquisition. Or at the fair value as at the date of acquisition. So, in measuring NCI, the question will obviously state how it should be done, but there are two ways, either as a percentage of the net assets at acquisition or at the fair value at the date of acquisition. The first technique is easier because it has a shortcut and is also more common in practice. With this method, you pick the NCI's percentage, or you find the NCI as a percentage of the subsidiary at reporting. It's as simple as that. So we are done with calculations for our major workings. Now, what is the suggested step-by-step approach? Step-by-step approach. Suggested step-by-step approach. Step 1. Establish group structure. This will help you determine if the parent has control or not. A simple drawing like this will do, indicating A's percentage, say 60%. Obviously, A has control over B. Step 2. Perform double entry to record any individual company adjustments that must be necessary. Perform double entry to record any individual company adjustments for any individual company adjustments. Step 3. Set out a pro forma statement of financial position or a skeleton statement of financial position. And fill in the missing figures. Step 4. Calculate the net assets of the acquisition date and reporting date. Net asset at acquisition and reporting dates. Step 6. No, sorry, step 5. Calculate goodwill. Step 6. Calculate NCI. And finally, step 7. Calculate the consolidated retained earnings. And that is all for consolidated statement of financial position. Alright, thanks for watching. We've done the introduction, a brief intro about the whole consolidation, and we've gone through major workings and how each major working is calculated, and we ended by looking at the suggested step-by-step approach to consolidated statement of financial position. In our next video, we will start with work examples on each of these and how to bring all of them together to prepare the consolidated statement of financial position. Again, subscribe, like, and share. Thanks for watching. See you in our next video.